Good afternoon. My name is Alicia, and I'll be your conference operator today. At this time, I would like to welcome everyone to the Park Aerospace Corp. Second Quarter 24 Earnings Release Conference Call and Investor Presentation. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press star 2. Thank you. At this time, I would like to turn the call over to Mr. Brian Shore, Chairman and Chief Executive Officer. Mr. Shore, you may begin your conference.
Thank you, Alicia. So welcome, everybody. This is Brian, of course. Welcome to our fiscal 24 second quarter investor conference call. With me, as usual, Matt Farbauer, CFO. Make sure you're accessing the presentation. We announced our earnings just a little while ago, and there are instructions as how to access the presentation we're about to go through. Also, it's posted on our website if you want to do it that way. So what we're going to do with this presentation, maybe a little bit of a different approach, is that we'll focus on our second quarter dynamics and then longer-term outlook dynamics for our future. And we'll skip over some things like the trend information regarding industry trends. And then we'll go right to questions. But you know, it probably still take 45 to 50 minutes to get through our presentation. And of course, before we proceed, I want to just mention to you that we're in our 70th year in business. So let's go do it. Slide 2 is our forward-looking disclaimer information. Let us know if you have any questions. Slide 3 is our table of contents. Slide 1 is our Q2 presentation, and we have supplementary financial information in Appendix 1. And we don't intend to cover that or discuss it. If you have any questions about it, please let us know. A picture of the Airbus A321XLR, which is an important potential program, future program for Park. Let's go on to Slide 4. Let's slow down here a little bit. Our quarterly results. So let's go right to the right-hand column there for Q2. If you notice, the revenues are way down from Q1, about $3.1 million. We'll discuss that in detail, of course. But I also want to highlight for you, and it is highlighted, actually, to make it easier, in yellow, the gross margin of 32.7%, which to me is quite outstanding when you look at the comparison to Q1 with a $3 million top-line loss and a 32.7% gross margin. That doesn't happen by accident, I don't think. You know, we always comment that we don't like our gross margin going below 30%, and it does every now and then, and we tell you that. I was actually a little bit surprised myself with the top line loss of $3 million. You know, I thought, boy, our gross margin isn't going to look so good. So I was very pleased with that number. And we have an EBITDA margin of 21.4% as well, which is pretty good. Let's go on to the text at the bottom of Slide 4. So what did we say about Q2 during our Q1 investor call? You remember? We said, well, we didn't provide any sales or EBITDA estimates for Q2. Why is that? Because we knew there was a burn down coming. We told you about that, but it was kind of new information for us, and we didn't have any quantification of it. So we said, you know, to give you a forecast for Q2 during our Q1 call would have been just guessing, and that's, you know, kind of doing you a disservice. We warned you, in a sense. We said, hey, something's coming, but we didn't know yet. We had to spend time with our customer, MRS, to understand the scope of the burn down. So now we understand that, and we can discuss it with you in detail, which we will. The second check item, why did our sales drop $3.1 million from Q1 to Q2? Well, it's just a coincidence, but the sales drop is explained completely 100% by a $3.1 million drop in GE Aviation jet engine program sales. It just so happens it's exactly the same number. And if you do the math, you know, this is not stuff for brilliant people, but the non-GE Aviation jet engine program sales were essentially identical in Q1 and Q2. Obviously, that would make sense. So let's keep going. Let's go on to Slide 5. Since all the GE Aviation jet engine programs, which Park supplies into, are ramping up and going strong, which they definitely are, why the steep drop in GE Aviation program sales in Q2? What's going on here? Well, you already figured it out. It's about the MRAS inventory burn down, which we'll discuss in great detail later in the presentation. So we'll get to that. We'll go into detail about the burn down. But let's just go back to our Q2, a couple of things we want to mention. What other considerations are there related to Q2? How are things going with supply chain, freight disruption, and staffing challenges? We talk about those three things every quarter for, I don't know how long, you tell me, a couple of years at least, because they've been really important factors for Park and running our business. The challenges continue, but things seem to be improving. So what does that mean? It's not like they were before the pandemic. The lead times are longer, but it's something that we can count on more. During the worst part of this deal, it didn't matter the lead times were, or we wouldn't be given lead times. We'd say, look, we'll get it to you when we get it to you. We don't even know. Or we'd be given a lead time and we'd blown, and it made it very challenging to run our business from a production management perspective, from a supply chain perspective, from a staffing perspective. So a lot better. We still have longer lead times, but as long as we kind of take those into account, we're able to manage our business much better than over the last couple of years. Total missed shipments in Q2, approximately 220,000. The number's down. We still would like to be zero. Our people think they did an outstanding job to bring the number down. And what is it about? Want to guess? Probably you can guess already. International freight, that's been the thing that's really been the toughest for us. I think we're doing better with that as well, but we still get surprises with international freight. Our margins continue to be affected by inflation and costs related to a recently commissioned new plant in Kansas. We'll go into details about those things because we covered those in the last 2 or 3 presentations. You want to go back and take a look. Got any questions about them, let us know, but I just want to flag those things continue. Let's go on to slide 6. Important here. Before we move on, I believe we must give a special shout out to Park's people for their outstanding job, in my opinion, in delivering the margins they achieved in Q2, considering a $3.1 million drop in revenues compared to Q1. So there always will be some quarter-to-quarter variability based on product mix. And it was in our favor, so let's say that. It was in our favor in Q2. But notwithstanding all of that, our Park people did an outstanding job in Q2, in my opinion. So, Park, you probably know us by now pretty well. We're not the fanciest company in town. We don't have a lot of people done with the fancy B schools, but our people are old school, and our people know how to make money for our owners. And to me, that's probably pretty important for our owners. You can tell me if you disagree, but if I was an owner, I would think I want people who are dedicated to making money for me. In my opinion, our Q2 was one of our best Park quarters. Why do I say that? Because, when things are going great and your sales are up and everybody's a hero, everybody's, get the employee of the year, the company of the year award. To me, that doesn't mean anything. When the chips are down, you still deliver and perform. That, to me, is an indication of a very good, solid company. So that's just my opinion. You can disagree. Let's go on to slide 7. I won't talk about slide 7 too much. It's in every presentation, just kind of for perspective and reference. Let's go on to slide 8. Okay, we always do our top 5 customers every quarter, so we're continuing this tradition. Aerospace, they're a rep in Israel, and they rep Israeli aircraft for us. Israeli aircraft makes the Gulfstream G280. I don't know if you're aware of that. That's actually made under contract with Gulfstream. So they made the top 5. Kratos is in our top 5, I think, pretty much every quarter. Wonderful, wonderful customer. We love them. And we got a great photo here of the Valkyrie, and it's doing a loyal wingman demo flight with, guess what, the F-35 and F-22. So I would think of the 3 different airplanes, the Valkyrie is probably a lower cost of the 3. So I'm being a little sarcastic, I guess. Middle River, we could use a lot of programs here, but we use the Comac 919, Lifeport. They kind of through some circuitous means took over some of the AAR structures business that we used to supply into. Nordam, we chose the 737-800. That's for the Weathermaster radome, which is on the 737 line. Let's go on to slide 9. Our pie charts. I always like these. I don't know if you have any opinion about it, let it know, but let me know. I think they're useful. Look at the difference, 21, the pandemic year, 22 and 23, very similar. First 6 months of 24, commercial's down a little bit. Why is that? That's because the burn down was all commercial, in Q2. So, okay, let's go on to slide 10. Another one of our, traditional slides. We love niche military aerospace programs, which we certainly do. This is Elena's project every quarter. She's our head of customer service. MK-125 warhead, that's on the SM-2, SM-3. That stands for Standard Missile. You probably know that. This is a picture of the Standard Missile 6. These are some outstanding missiles. I believe the SM-2 is a hypersonic missile. The Alenia C-27J Spartan, radome materials, Sikorsky. We just have a lot of stuff, a lot of materials on Sikorsky. And the MK-41 vertical launching system, a little bit different here. Parts using our material. It's actually not ablative. Then we have the pie chart. Rocket nozzles, drones, radomes. We consider those to be niche markets for Park, but even for us, aircraft structures is a niche market. We don't go for the big programs for aircraft structures where, it's a lot of margin pressure. It's just not really for us. Okay, let's go on to slide 11. And here's what we're going to skip. This, slide 11 through, what was it? Let's figure it out. Yeah, through 15, pretty much as very few changes from Q1. So, if you want to ask questions about that, that's fine, but let's just skip over it. We included just for perspective and context. Let's jump to slide 16. Okay, so this is a slide that we include every quarter just to kind of give you the lay of the land. GE Aviation jet engine programs, obviously very important to Park. So we have that, for those you don't know, firm pricing LTA, that's a requirements contract from 19 to 29 with MRAS, Middle River Aerostructure Systems, which is a sub of ST Engineering Aerospace, a large Singaporean aerospace company. We built that redundant factory. When we said, we'll build you a factory if we sign the LTA. So, of course, we live up to what we say. The factory is complete. It's in production. You know all that. So let's go on to the next item. Sole source for composite materials for engine nacelles and TR, thrust reversers, all these programs. So you're probably thinking, if you don't know us too well, what's going on here? These are all GE Aviation programs. What's the connection? Well, that would be an excellent question because they are all GE Aviation programs. So the connection is that when we first got involved and did the LTA and everything, MRAS was a sub of GE Aviation. Subsequent to our getting on these programs, GE Aviation sold MRAS to ST Engineering. So that's the little secret there. Boeing 747, those are spares. They terminated, they canceled the program. We're still making spares. Let's go on to slide 17. So let me explain something. Park Composite Materials are sole source and primary structures on a primary structure component for the Passport 20 engine for the Global 7500, 8000, not included in the MRAS LTA. This is a little confusing because for the nacelles and thrust reversers, that is included in the MRAS LTA. This is a different structure. This is a primary structure in the engine, and that actually is not part of, that's on an MRAS program. That's a GE Aviation program, and that's why that component is not included in the MRAS LTA. But you shouldn't believe that the Passport 20 engine program is not in the MRAS LTA because for all the cells and TR materials, it is in the LTA. Then fan case containment wrap for the GE9X engine for the 777X aircraft. That's produced with our AFP composite materials, not included in the MRAS LTA, not yet anyway. And the reason I say that is this program seems like it's about to move, and MRAS has already said they want to get into the LTA, so let's see what happens with that, but not at this point. It is through MRAS, it's just not in the LTA yet. MRAS qualification of two proprietary film adhesive formulations in progress. That's wonderful news that the qualification's in progress. Park MRAS, I always put them first, MRAS Park LTA through 29. It's recently amended to include 3 Park film adhesive product forms for composite bond and metal bond. Again, very wonderful news. And then the life of program agreement, we talked about that last time. It was requested by them. What's it worth to Park? I don't know. What's the life of program? 20 years, 25 years? I don't know. And if you look at, I think it's our outlook was at slide 34, we say it's about $55 million a year. So you could do your own math and figure that out. Now, starting, if we continue after 29, which, most betting people would say, yeah, we're going to continue, that number will be higher because, pricing would go up at that point, of course. But, just do your own math if you want to. Get a, little calculator on your iPhone. So slide 18. Update on GE Aviation jet engine programs. The A320neo aircraft family, the CFM LEAP-1A engines. That's the 319neo, the 320, 321, and the A320-1LR and XLR. This is the big dog. This is the big, the big kahuna in the GE Aviation in terms of our GE Aviation work. Airbus has a huge backlog, and I would say that's huge, of A320neo family aircraft of 6,720 airplanes. That's a lot of airplanes. I mean, I'm sorry. During the Airbus's first half earnings call on July 25, 23, they just reaffirmed their plan to achieve a rate of 75 A320neo aircraft family deliveries per month in 2006. Did you get a little nuance there? Because they were saying the end of 2026. Not saying that anymore. They're just saying 2026. I don't know if I'm reading too much into it, but they're just not saying end of 2026 anymore. So I don't know. I'm not sure what's going on there. Maybe it's nothing. Will Airbus achieve that rate in 26? Hard to say, but based upon their huge backlog, there's very good reason to believe they'll get there in 26 or sometime in the not too distant future thereafter. Here's a nice picture of the A321neo. That's their biggest seller in that family at this point. How's Airbus doing with their planned ramp up? Let's go on the slide. What is it? 19. Not too bad, according to reports. 23 year to date through August. I don't have September in here yet. It was, I've been working the presentation for a couple of weeks. September's info is not, I don't think, reliable yet, so I just didn't go there. Airbus delivered an average of 43.5 neo aircraft per month, so we're getting there. But here's something interesting: delivered an average of 50 in the last 4 months through August. So you would say that's moving in the right direction. I think you would say that. Clearly, though, based upon their huge backlog, they would already be at 75, a rate of 75 per month, if not for supply chain restrictions and limitations. That's probably obvious to you. What about the engines, though, for the A320neo aircraft family? What about those engines? Well, in our review, the A320neo aircraft family offers 2 approved engine options, namely the CFM LEAP-1A engine and the Pratt 1100G GTF engine. Now, Park supplies into the A320neo aircraft family using the CFM LEAP-1A engine. We have no content on the A320neo family using that Pratt engine. Now, here's something really, really interesting. The CFM LEAP-1A's market share of firm engine orders for A320neo family aircraft has been hovering around approximately 60% the last 2 years or so. And you know that because every quarter we talk about it. So you people that are pretty regular with Park, you've heard that 60%, more or less number, that kind of 59, 60, 61 range for a while now. But what happened? Let's go on to slide 20. That's all changed. In the last few months, the LEAP-1A has broken out as a clear market share winner for the A320neo aircraft family. Now in red, the CFM LEAP-1A market share of firm orders for the A320neo aircraft family has jumped to 66%. That's just July 31, 2023. Well, that's a huge jump. Why is that? This huge jump in market share is quite remarkable when one considers there are 12,348 firm engines. Firm engine orders for the A320neo aircraft family. There's so much ballast in the market share that a significant change, like a 6% in market share, would be considered to be highly unlikely. In other words, if there are 20 engines ordered, somebody gets 5 orders. Well, that's good. You really move the needle. But you have over 12,000 engine orders. It takes a lot to move that needle. 6% is just shocking, huge number. Well, what's going on here? Shocking to me, anyway. That's my opinion. I mean, maybe other people don't agree, but what's going on here, though? Why? Slide 21. Just a little aside. A delivery rate of 75. A320neo family aircraft per month, a 66% LEAP-1A market share translates into 1,188 LEAP-1A engines per year. That's just doing math. Sorry. I mean, if you got a little calculator on your iPhone, you can do that yourself. What is that worth to Park? Well, according to our outlook, it would be worth $36 million per year. Yeah, just do the math again. Do the math. Because we know what our content per engine is, $36 million per year. That's just for the A320neo family. There currently are 8,144 firm LEAP-1A engine orders. What is it? What are those firm orders worth to Park? Well, that's a little bit more difficult to say because some of those airplanes will be delivered after 29, and like I said, if you're a betting person, you're going to bet will continue after 29. But our prices will go up after 29. Now, the prices also go up in 25, so there may be an offset. So this year and next year, prices will lower. They go up in 25, so it's kind of, 6 of one, half dozen another. But you could do your own math. You can multiply 8,144 by, if you want, 30.5. That's how much it is per that's 30,500 per unit, not million. That's about $250 million. So that's just in a rough kind of guesstimate. That's not the program. The program will continue, and there'll be more orders. I would expect. What happened anyway? So back to the main point here. Why is the market share of firm engine orders for the A320 aircraft family? Why has it shifted so abruptly and dramatically in favor of the CFM LEAP-1A engine? Very serious issues with the Pratt 1100G engine. Now, we talked about this a little last time to go with durability, but we're talking about a different category of issues now. These issues have been extensively reported, and as a result, we will not attempt to cover them in detail here. However, the Pratt 1100G engine issues are expected to ground 350 A320neo family airplanes per year through 2026, which is met with as many as 650 groundings in the first half of 24. Now, that's not some, analyst or commentator. That's from the company. That's what they're saying. You run an airline, you don't make that much money to begin with. You don't want airplanes grounded. That is death for an airplane. You can't have airplanes grounded. That's why it's such a serious issue. And let's go on to slide 22. And this also comes from the company. It's not somebody's opinion. The inspection and repair work is expected to take up to 300 days per engine. So we're talking about, grounding airplanes for a long time. Very tough situation. It's difficult to fully comprehend the full implications of the crisis and where it's going, but the story may not be over, may be far from over. My take on it is whenever it seems like a crisis can't get any worse, it does. That's just my take on it. Will this crisis lead to significant additional A320neo aircraft family market share gains for LEAP-1A engine? Many believe it will. What do you think? I mean, the dilemma is that people are, ordering these airplanes, a lot of them. They got to choose which engine they're going to go with. So, think about that a little bit. Let's go on to slide 23. The top item, that's still in the A320 Neo family. This is the A321 XLR. Just want to highlight that. That's that it's supposed to be entry into service in the second quarter next year. Boeing doesn't have a response, and this is a real important program for Park. A lot of we see a lot of writing about it now. I think people in the industry are getting pretty excited about this aircraft. We covered it in more detail in the past, and I won't do that for you, but it's definitely, we would say, a plus. A COMAC 919 with those LEAP-1C engines. COMAC plans to achieve a production rate of 150 C919 aircraft a year within 5 years. That's what they say. That's not some analyst. That's what they say. Note, when we get to our outlook, I think on slide 34, we're only assuming 100, so just keep that in mind. They currently have over 1,000 orders. And 2 919 aircraft are currently in service with China Eastern. Let's go, nice picture of it here. Let's go on to slide 24. Still in the 919. China Eastern recently announced an order of 100 additional 919 aircraft to be delivered between 24 and 31. This is the largest 919 order to date. And then Gallop Air of Brunei recently announced an order of 15. And why would I even tell you that? 15 orders doesn't sound that much. The reason is because until now, the COMAC airplanes have been considered to be China market airplanes only. Like they'll sell a lot of these, but only into the China market. Well, obviously Brunei, if you know your geography, that's not part of China. So that's why I thought I'd highlight that. Very interesting. And then let's talk about the COMAC ARJ21. That's the regional jet with those GCF3410A engines. According to COMAC, 112 aircraft have been delivered and service, 775 open orders. And here you go, Gallop Air Brunei, they announced an order of 15 of these airplanes. So again, previously thought to be a China-only kind of market, but Brunei's not in China. So here's a nice picture of the ARJ21, a regional jet. Let's go on to slide 25. Okay, so the 777X with G9X engines, we talked a lot about, last few quarters about the issue with the fan case redesign. If the fan case redesign is successful, then the case wrap won't be needed. I'll give you my perspective based upon things I know, which is, I guess, considerable. I think that chances of that happening are kind of fading away. I think this, my opinion is this will be a real important, exciting program for Park for a long time to come. Plant entry into service, 25. Currently an active program for Park. You should know that. This is currently an active program for Park. I don't want to say too much more about it, but I feel quite encouraged that this is not going away and it's going to be moving up. Potentially significant program for Park, so we're happy about that. Always got to give honorable mention to 747. We're still making spares for the 747. Slide 26. This slide you're familiar with, a couple little changes though to it. GE Aviation jet engine program sales history. Won't go into the history, just look at the right-hand column though. Look at Q1 to Q2, 6.2 to 3.1. There's a $3.1 million difference, and I think that's about half, isn't it? Yeah. For Q3, we got $4 million booked, but it's not a forecast because there's so much uncertainty, which we'll talk about a little bit more when we get into burn down regarding Q3 and Q4. So book, we would expect to be less than that, but we're not giving you that as a forecast. We're just saying this is what we know, and we're not giving you a forecast. We just don't feel comfortable. Now, one thing I want to add is on the right-hand little box here, see 9.4 million. Remember we said earlier, same amount of non-GE Aviation programs in Q1 and Q2. So that annualized at 37.5 million. And I just want to remember that number, 37.5 million, if I forget when we get to our outlook. So we'll talk about that again when we get to that outlook, I think on slide, 35 or something like that. Okay, let's go to slide 27. Okay, now this is the painful part of the presentation. GE Aviation sales are all about the MRAS inventory burn down. The sharp drop off and Q2 GE Aviation program sales is all about MRAS's burn down of Park inventory carried by them and its subcontractors. Now, this is the really key point. The MRAS calendar year 22 build plan, that's their build plan, not our plan. Their build plan. This is saying this is what they plan to build in 23. We got a build plan through, I think, 20 or 29. This comes from them, not us. It translates into approximately $23 million of calendar year 23 Park GE Aviation GE program sales. It's very easy to do the math. Once we know how many units they're going to build, we know how much material is used per unit. We know what we sell the material for. So it's very easy to do that math to get to 23 million. That's a pretty precise number, assuming the build plan is correct, and normally it is. That's approximately 5.75 million per quarter. So the MRAS calendar 23 build plan is reduced to some extent. This is just a side point because MRAS is carrying excess finished structures inventory as well. I was reluctant to put this in because it could be confusing. This is just saying their build plan would be more, except they have their own inventory. That has nothing to do with Park inventory. As far as Park's concerned, what matters is their build plan. Okay, that's what matters. That says this is how many units they're going to build, and that will drive how much Park material they're using. But since MRAS's 2023 build plan translates to 5.75 million in Park's GE program sales per quarter, why were Park's GE programs sales only 3.1 million in Q2? Well, I guess we already kind of gave away the little secret, but what explains 2.65 million? That's just math. That's taken 5.75 subtracting 3.1. What explains the $2.65 million gap between Park's expected Q2 GE program sales based upon the build plan and Park's actual Q2 GE program sales? Well, again, it's all about the burn down, the MRAS burn down of Park's inventory carried by MRAS and its subcontractors. The inventory burn down explains 100% of the gap or shortfall, which makes sense because, as we said, the programs are ramping up. The programs are going strong, so why would our number be down? Well, that's the explanation. That's 100% of the explanation. Let's go on to slide 28. Why the inventory burn down? Why the surprise by excess Park inventory being carried by MRAS? Now, I'm going to say something I mean very sincerely. MRAS is a wonderful customer. The relationship between MRAS and Park is very special and unusual, and Park is very fortunate to have such a wonderful customer as MRAS. and have such an unusual relationship with MRS. Now, this is not just BS, no way, that's not true. I've been doing this job for a long time, and I've dealt with lots of customers over the years. Some were really good, some were not so good. But this customer is special, I would say, quite special, and the relationship with them is quite special. It's really a true partnership. And if you're around a while, you get nervous when a customer talks about being partners, because that means when they want something, you're partners. When you want something, you're not a partner anymore. But with MRS, I gave you a dozen examples without even thinking about it. It's been a true partnership. Win-win. True. The sourcing people are very enlightened, I would say. Very enlightened people. But to put it kindly, maybe inventory management is not the aerospace industry's strongest suit. Now, what's going on here? I'll give you my opinion. I'm not an expert in the aerospace industry. It's a strange industry, no doubt. It's very risk adverse and resistant to change, but that's for obvious reasons, because of safety. The FAA doesn't want, some OEM or contractor to making change willy-nilly to airplanes or its structures, its systems. That would be, danger. Chaos would be dangerous. But there are some collateral effects, in my opinion, again, related to this, or being risk adverse and resistant to change. So what happens in the aerospace industry, in my opinion, again, is the players tend to go on autopilot too long. They tend to overshoot. They just kind of get something locked in, and they're not paying attention to the signals that much. They're not that much agility, let's say. So it may be a little bit of a byproduct of being risk adverse and resistant to change, which is good because that's for safety. So what happens is that can lead to increasing oscillations with these overshoots. You wait too long, you're not reacting, and then by the time you realize, you're 6 months late in reacting, then you have to, the correction is, could be pretty extreme. So for Park, we're not going to change the aerospace industry. We chose to be in the aerospace industry. What does it mean for us? We need to be really agile, flexible, and have a lot of urgency in how we manage our business. We're certainly not singling out MRAS. They're probably better than a lot of other, companies in the aerospace industry. But this is, I guess I'll, try to be kind of delicate about this is what's going on here and why we have this surprise and this inventory burn down. Will this kind of inventory surprise happen again? Likely will happen no matter how closely we work with MRAS, and work with them really closely. There's nothing hidden or anything like that. It's very transparent. It's happened before, likely will happen again at some point in the future. So there may be, likely will be, some degree of quarter-to-quarter volatility in our GE program sales because of inventory management challenges. Maybe somewhat of a roller coaster from time to time. That's just the way it is, in my opinion. Slide 29. But considering all the wonderful things which have resulted from the relationship with MRAS and the many wonderful things still expected to come from the relationship, on balance, there's no question whatsoever in our minds that we are extremely fortunate to have MRAS as a customer. On balance, not even close when you consider the plus and minuses. Not even close. Nothing to talk about. Not even close. No, there may be quarter-to-quarter G program sales volatility in the future. We're happy to work through and deal with the volatility and challenges presented by it, because to us, the overridingly important consideration long-term is long-term outlook for G program sales, which we explain in slide 34. Yeah, it causes it causes challenges with our production management, with supply chain management, with our staffing management. We're happy to deal with it. On balance, not even close. So where are we going with the burn down? Based on the information we have a lot. We believe the burn down will likely be completed in our Q3, and our Park inventory, the Park inventory carried by MRAS will be quote-unquote normalized by the end of Q3. We put normalized in quotes for a reason, because that's kind of a complicated term. Let's go to slide 30. One more consideration regarding inventory management. As a general matter, we kind of touched on this already, it's very important to avoid overcorrecting, as doing so, kind of overshooting, can create additional volatility with increasing sine wave amplitudes and inventory swings, like oscillations, So you probably know what that means, sine waves that kind of go up and down. You've seen that. This is a concern of ours and others. We're not the only ones, and I won't mention who. But we're not alone in this concern. If our concern is well founded, it could result in a significant spike in demand in our Q4 and into 25. So that shouldn't be a real surprise we shall see. But in the meantime, we're keeping our antenna up and our ears to the ground. Let's go on to slide 31. This is kind of, I think, kind of summing it up for us, for me anyway. In any event, what do we think about all this? What do we think about all this? We think mostly short-term noise and static. Now, like I said, we have to deal with from a management perspective, the oscillations, the ups and downs. But in terms of what matters to Park, long-term, mostly short-term noise and static. We think the freight train, the juggernaut, is coming down the tracks at us 100 miles per hour, and it cannot be stopped. See that look in slide 34. We're not fooling around here. We think we better be ready, or we too will be overrun. That's what we think about it. So let's go on to slide 32. Okay, financial outlook. How are we doing with time? Financial outlook for Park and GE programs, a little bit of an update. Okay, because of uncertainty with Q3, because of burn down, Q4, because maybe the spike, very difficult for us to provide meaningful forecasts for Q3 and Q4. We're not going to, what's the point of guessing? We're just doing you a disservice. When will we be able to resume providing quarterly longer-term forecast estimates? Not sure. We'll definitely keep you posted. But we are able to provide the following updated revenue outlook for GE Aviation jet engine programs and financial outlook for Park generally. And we believe the GE Aviation programs and Park outlooks are much more meaningful and significant than quarterly forecast estimates, because the quarters go up and down because who knows why. But the key thing to us is what's the long-term outlook? What are the long-term prospects? That's more meaningful for us, and that we have a better feel for as well. What's the timing for the outlook? We have the outlook, and 1 year is like what people say, what year is that? It's like, we're not sure what year it is. I mean, if the CEO of Airbus says that they're going to be at 75 A320neos in 2026, what am I supposed to say? No, he's wrong? I don't know, but I mean, so we don't know. Why play the guessing game? We're not sure, but as I said, and this is the key thing for Park, the freight train is coming, it can't be stopped, and we better be ready. And slide 33, these are the assumptions we use. I won't go through them. These are the same assumptions that we shared with you last quarter. Going to slide 34. I'm going to stop here. I know we're running late, but this slide requires a little bit more discussion. See the $55 million number? Is that an aggressive number? Well, let's go through it. Let's go through the math. A320neo, 1188. Remember we talked about the number before? We're just doing the math. It's 75 per month, 66% market share. We're not assuming that market share is going to go up. It might. We're not assuming that. And we know what the revenue per unit is. There's $36 million per year from the A320neo. This is assuming 25 to 29, 25, 29 pricing. That's for 20. That's for the global 7,500, 8,000 aircraft. 90 airplanes. That's the low end of the build plan. We have low numbers and high numbers from the MRAS for the build plan. It's a low end. So we're being aggressive. C919. What did I tell you? Comac said they're going to be at 150 in 5 years. That means 300. These are you got to convert 2 engines per airplane. Okay, we're just using 100 equivalent, 200 engines, 100. Now let's talk about that. The A320, they're predicting 900 airplanes per year. The 737, they're just talking now, but they're going to go to 57 per month. That's 684 airplanes per year. We're talking only 100, which is 50 less than what Comac says. Is that aggressive? I don't know. And again, the revenue per unit, those numbers we know. ARJ21, that's the regional jet. 55 is lower than the low end of the build plan range. There's, 2 numbers, high and low. This is lower than the build plan range. Are we being aggressive? GE9X, we're not going to give the unit numbers, but I can assure you it's conservative. Now, the total number went up. Why is that? Because the revenue per unit went up because we have new pricing. And the pricing is we're taking into account the new pricing. That gives you the 77.5 million per year. Pretty conservative number of units, I would say. So let's talk a little bit about some of the footnotes here. Okay, so item 3, footnote 3, A320neo aircraft. Park assumes film adhesive materials qualify and use in this program. Is that aggressive? Well, I don't know. You tell me. We're qualifying. And that's a lot of money for MRAS as well, qualifying their film adhesive products with them. They're hiring engineers. They got a big investment. Why would they be doing that if they don't plan to put the film adhesive on their programs? You know, is that aggressive? Well, I don't think so. Let's talk about some more. Item 5, Passport 20. Item 6, which relates to the 919. And item 7, which relates to ARJ. We're assuming in every one of those cases our film adhesive is not used in the program. Why is that? Because, I mean, clearly MRAS wants to get their film adhesive products on all these programs. They don't want to have to buy film adhesive from brand X and also from brand Y. Why are we doing it? Because we're being conservative. Why are we assuming rather they're not in the programs? We're being conservative. But you tell me, $55 million, is that an aggressive number? An aggressive number? I don't think so. We're just doing math here, folks. You know, so if people think that we're, you know, kind of overdoing it or promoting or hyping, I don't know where you see that. Let's go on to slide 35. Okay, now, Park Aerospace core financial outlook principally based upon growth estimates of programs on which Park is sole source qualified. An update. All right, this is pretty much very similar, although we've updated the estimated GE programs incremental sales to 32.7. That's just doing the math again. And there are footnotes that on the next slide 36, which, you know, explain the math here, which we already pretty much know because not too many changes. It's $20 million for the ADL, Kratos, PAC-3. You know, somebody said he thought that number was high. It's like, okay, I don't know where you get that information from. To me, this number is conservative, quite conservative. But you know, I guess we'll see about that. Non-GE programs incremental sales. Well, that's interesting because remember we're using baseline of 23, where there's non-GE aviation sales for 32 million, and 8 million brings it up to 40 million. That's the assumption here. 32 plus 8 is 40 million. That assumes, like, you know, what we say 5% a year over 5 years, something like that. Where are we in Q1 and Q2? We're at 37.5 million. So 5.5 million of 8 million has already been achieved. Now, that's Q1 and Q2. It could go down. I mean, I'm not saying that number will move up and down, but it always does based on timing of programs, you know. That's just how Aerospace works. But I just want to point out, again, are we being aggressive? I don't know. I don't see it. And the rest of the math, you know, you could just follow through and follow along yourself. You can see how we get to $36.5 million of EBITDA for Outlook. Let's go. So slide 36, I'm not going to go through these items. These items just kind of explain detail, the kind of things we already talked about, how we could do the math. If you have any questions, let us know. Slide 37, let's stop there for a second. Just remember, very importantly, this is an outlook. This is not a forecast. Why do we say that? Because the outlook does not take into account lots of other programs we're working on. We're not sole source qualified on them yet. We're working on. Now, some will hit, and maybe some won't, but some will. And some of them are pretty big, you know, significant revenues. The bullet items, the first one, we're talking big stuff here. The second one, okay, we announced we have a new film adhesive product line. What do you think? We don't want to sell any of it? The only film adhesive sales in any of the outlooks is for the A320neo. Nothing else. Nothing else in GE. What about other customers? You think we're not approaching other customers? Of course we are. And we have a lot of interested customers. So kind of like, yeah, we are actually planning to sell that product to others. It helps a lot, by the way, to say, yeah, we're getting qualified in a big program in terms of credibility. The Asian JV, we talked about that before. Structures Assembly Integrations Project, that could be a big one. Technology license could be big. Israeli Arrow 3 missile defense system could be big. So just want to make the point again, none of that stuff is included in our outlook. Now, we're not going to do that. We're not going to quantify it for you because some will hit, some won't. But some of these are big ones. You know, they're like binary. It might be zero. It might be a lot more than zero. But it probably won't be somewhere in between. Let's go on to slide 38. Okay, these are updates, just I guess by coincidence almost, on the 3 programs that total that $20 million in the outlook: the ADL program, the Kratos program, and the Pack 3. I won't even read through it for you. I think everything's positive. I guess the only thing to highlight is the Kratos the replicator program. That's something that DoD has announced recently. This is, I think, very positive news for Kratos and the Valkyrie. Very, very positive news. Seems like the government is really going for it with these automated unmanned systems. And the Valkyrie seems to fit right in there. Whenever any article I see about it, Valkyrie's always mentioned. About the replicator program. About the PAC-3 missile. Everybody wants it, and what's holding it back, I guess, is supply chain. Let's go on to slide. Missed 40. Okay, slide 40. Kind of going long on time, but we're getting there. Hang in there for a second, please. So this is a slide we shared with you before, $74.2 million. So we're paying down that transition tax installment payment. We paid $3.2 million in our Q1. $9.3 million. As far as I'm concerned, you should consider that to be money spent. That's money that's owed. It's almost like debt. Like that. We don't have any debt, but it's almost like that, yeah. And that money, that gets paid, there's 2 more installments. The last one is in June 25. That money will be gone in June 25, so you got to consider that money gone. The $6 million for the Torita project, we'll see about that, and there are a lot of other projects, some of which I kind of referenced in some of the outlook discussions that programs that would require investment. So we'll see about it. But it looks like, kind of conceptual number, 58, 59 million. That's not a forecast, but it's kind of how we look at things in terms of, okay, this is how much money we have. This is kind of how much money is committed. And, obviously we hope to be generating cash as well. So that's why I said it's not a forecast. But for us, it's conceptually important. 41, our balance sheet, cash dividend history, and buyback. Every quarter we cover this. We got 0 long-term debt, dividend history. While others cut or cancel their dividends, Park maintains regular quarterly cash dividends throughout the pandemic and economic crisis. Park has paid 38 consecutive years of uninterrupted regular quarterly cash dividends without ever skipping a dividend, reducing dividend amount. And the big one in blue, Park has paid $586 million bucks, or $28.60 per share in cash dividends since the beginning of fiscal 05. And as I always say, that's a hell of a lot of money for a little company like Park. And as announced on May 23, 22, our board authorized Park's purchase of up to 1.5 million shares in company's stock. Then on May 12, 2023, Park implemented a Rule 10b5-1 program, which expired by its terms on July 7, 2023. Under that plan, we purchased 221,099 shares of our common stock, an average price of $13.02, total cost of $2,879,000. On August 11, 23, we implemented another 10b5-1 program, which expires by its terms today. Under that plan, no Park stock has been purchased. And we're just about wrapping up here. The Park family, slide was at 43. Yep. The secret continues. The secret to our success continues. Okay, we're giving you an update on our Customer Flex program. We haven't done that the last couple quarters just because we're trying to, for brevity, but total participation 62%. Don't read something negative in that. We have quite a few new people, and it takes a little while for them to be qualified to be in the Customer Flex program. So still a very important program, very, very important for our success now and in the future. Park family, the Park family current people count, 119. That number a little higher than you're used to. Our short-term plan is to add another 15 employees and increase our Park people count to 134 Park people. So what's going on here? But before we get to that, just be advised that doing this will cost about $1 million per year extra cost, or if you want to use 110 people as a baseline, which is kind of where we have been for the last couple of quarters, that's $1.5 million of extra cost to our P&L we're talking about. And here's something interesting. This could happen relatively quickly, particularly for the production workers. And why is that? Well, to my shock, we started using social media for recruiting people. Corey, Courtney, and Nancy, they come up with really great ideas. I said, oh, okay, whatever, but what do I know? I mean, I'm guessing I'm not very good at this stuff. It's really helped a lot. It's made a big difference. And I think the other thing that's more important is that the Park family culture has taken hold. Courtney says it's a great place to work, and, we really believe that. Not an easy place to work, great place to work. And, I was a little frustrated because I thought, boy, we're doing all the right things. We don't lay people off. We love our people, or people are family to us. We treat people like family. Why is it hard to recruit people? I think we just had to stick with it a little while longer, and now it's taken hold. The word, I think, is out. And, we got light out the door of people looking to come work for us right now. So that's good news. But, watch our costs because, we could get up to that 134 number pretty quickly, especially for production workers. About half the 15 is going to be production-type workers. Okay, that's good news. Let's go on to slide 44. I guess it's good news. I mean, depending on how you look at it, slide 44. As previously stated, we need to get ready for the juggernaut. We, too, will be overrun. So our great Park people are committed to making money for owners every quarter. We run our business for Park's future for the long term, not for the next quarter. That kind of commitment is maybe what you call enlightened self-interest. I think that's a term where people realize for us to have a future, we need to make money for owners every quarter. If you're an owner, you want, people making money for you. But what do we mean here? We run a business not for the Park's future. In other words, we're hiring people or plans to hire people in advance so we're ready for the juggernaut. We don't get overrun. So in other words, we're not running for the quarter, we're running for the future. And our intermediate plan is to increase our Park people count to 143 people. So let's see what happens with that. At Park, we're very fortunate and blessed to have the great Park people we have. At Park, our people have been play for keeps. And we now have been on our 70th year of playing for keeps. And our tradition is we always feature some group or crew from Park. This is our Aerospace composite structures crew. So really emphasizing this because we're looking at significant structures and assembly program opportunities we're working on right now. This crew is very important. We're adding to it a little bit. This is also a very great group because they do other things. They do ITAR work. I can't explain that to you. I'm not allowed to do that. They're in the customer flex program, so they can do 2 or 3 other jobs. So very wonderful to have people like this. Anyway, operator and everybody else, thanks for listening. That concludes our presentation, and we're ready to take any questions that might be out there.
Great. Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your questions from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we pull for questions. All right, Brian, I'm not seeing any questions at this time. I would like to turn the floor back over to you for closing comments.
Okay, well, this is Brian again. Thank you very much, operator. Thank you all for listening in. Feel free to give Matt or me a call if you have any follow-up questions. And you have a good day, and we'll talk to you again soon. Take care. Bye.
Thank you. This concludes today's teleconference. You may disconnect